Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The WASDE report has come and gone, and as anticipated, it appears that the downturn in the corn market may in fact be fully discounted. That still remains to be seen, but as we had discussed last week, we're looking for 318 to pose as potential very good support. And if that were to occur, we're looking for prices to move up and to look to challenge 336 at a minimum, possibly getting up as high as 345. Today, the market's already up as far as 330. 336 looks like it's very likely that it will be touched. And we're looking at 345 as a potential target for this market at a very minimum. Upon the release of the news on Friday, you notice that corn made a very big downturn here. But you'll also notice the fashion in which it reversed off of the lows, coincidentally touching up right up against our natural support level. The market made a very nice strong reversal, indicating that higher prices were ahead. We've seen the last 3 days that the market has moved up nicely. We'll continue to be tracking to see how much the market's able to follow through with its strength. 2 standard deviations below the point of control is at 332 1/4, and you notice that's exactly the area at which the market is struggling with right now in terms of overhead resistance. We'll look for the market to have trouble here throughout the course of the day. If it is in fact able to close above this 332 number by the end of the day, we anticipate that we can see a very nice move up to about 345 by sometime next week. Here we have the December contract, and if you recall from last week, the key operating level that we pointed out consistently was 329. The market came through and was able to break through the 329 number briefly, turn back up around, continue to hold support above that 329, which is our 360-degree mark, and now we are well on our way potentially to touching that 347.5 that we had been projecting for you for several weeks. 2 standard deviations below the point of control sits at 331. Today the market is well above that 331 number, trading at about 339 or just shy of it at this time. Above here we see 381.90 is the long ways off from there. So the market has lots of space really to be able to maneuver and try to make its way higher. Getting up to 382 is probably not necessarily likely, but technically it is possible. But what we would be looking for here over the next 2 weeks is a sideways to up bias in the December corn contract. Here we have the September soybean contract, and what you'll notice here is the 979 number that we had been sharing with you is a 360-degree mark that coincides with our make or break region. After the market came in and tested inside of this area here, it was imperative for either 360 to hold or for it to be broken for the market to move through that area. Instead, the market has elected to hold this number at 979, and now we're seeing the market make its way up. A half cycle up from that 360 would land us at 1042.5, which is the minimum price objective that we've been looking at for a soybean to find potential resistance. Above that 342.5, he could even venture up to as much as 1108. Probably not likely, but that is possible. It would meet intermediate resistance at 1075 first. But for now, what we're doing or what we're looking at is the market simply tracing out key support and resistance. Over the next 2 weeks, it has a good chance of moving sideways given some of the news that we've been seeing with regard to weather. So as the market continues to make its way up, we have key resistance levels that we want to watch. So if the market's able to trade higher here through the end of the month, seasonally we're looking for a potential high to come in the early September timeline where a potential short could materialize. If you recall, we had a cycle timeline of about August 9th or August 10th for this contract. You'll notice here that the market came in, and from its move up, it paused. After pausing, it actually went sideways to down for about 3 days, and from there it has since picked back up again. One standard deviation above the point of control sits at 1050, and this is our short-term minimum price objective at this time for this soybean contract. It's been moving very nicely and looks like it wants to go up there, and we're looking for resistance to come in somewhere in the neighborhood of that 1050 number as this guy continues to trace his way up. He is well beyond 7 to 10 days from the low in terms of upward movement. If we take a Fibonacci time count and look at the number of days that he progresses up, the next time count is going to be 13. So we're looking at day 13 or trading day 13 for potential resistance as this guy makes its way higher. We can see much of the same here for the November beans contract. Here we had our make or break region or zone that tagged right at the 270-degree mark. So if we move one full half cycle up from that level, we're sitting at 1021.5. 1021.5 is potential very good resistance, but a close above this number or above this area should send us up to about 1053 3/4 at a minimum, and a full cycle move upward would land us at about 1086.5. Now, we don't want to get ahead of ourselves, in particular because the market right now is approaching being overbought. So on a very big move, on a surge to the upside, there you are looking at potential exhaustion coming in for potential topping movement. But again, we have that timeline looking at the end of the month or beginning of September, where we're looking for a top to potentially come in for this move to the upside to potentially look to be exhausted. One standard deviation above the point of control for this contract coincidentally sits very close to that 1050 to 1053 number. It sits at 1051 here. So again, we're looking at that 1050 range as a very significant, important area for this market, and would not be surprised to see lots of sell orders just below, perhaps at 1049 or so that as the market reaches that area, we're going to see very good resistance and a potential sell-off that could be very radical. September wheat has been inside of a very slow churn, but that slow churn has actually been moving slightly to the upside. You'll notice as you see the wheat contract here, its movement has been very steady, very tight ranges, but now we are approaching a former make or break region. Now, you'll also be able to take note of the fact that once it reaches up against this make or break region, we anticipate resistance again. This contract too is approaching being overbought, and we have two very important levels overhead for resistance. We have the previous 436 that we've discussed several times over, and we have what we consider to be our line in the sand, 440. If the market's able to make it up and touch 440 or somewhere close thereof, we believe that a very good sell-off will happen from here. In fact, this is a very good spot to price or to put orders out in the range of 436 to 440 because the market should have great difficulty getting beyond this area here. At the very least, what we anticipate happening is the market to reach up into this zone or into this area, and then we can see a sideways consolidation depending on where the market decides to go, and possibly another return back down to the downside. Here we have one level below the point of control sitting at 450 3/4. We don't think the market will even necessarily make it up quite that high, as that 440 line in the sand area is going to be very important for this contract. Once again, we've been very pleased with the time count and the movement that we've seen in the December crude oil contract. We talked about the low coming in, and once that low occurred, we were looking for a minimum movement of 5 to 7 days. That occurred right about here where the market actually did pause, and now that trend has continued higher and we see another leg back up to the upside. We're now sitting at day 10 up from the low, and again, if we take a look at a Fibonacci time count, what we would anticipate here is that the market would move up for about 13 trading days. If it's able to reach 13 or 14 beyond that 13 and trade at about 14 or 15, it could go up as many as 21 trading days. And so we're sitting at a very critical area for this particular contract right now. Some of the important price threshold that we had shared with you last week for potential resistance were at 46.21, 47.62, and at 51.13. We're well above that 46.21 number right now, and we're above the 47.62, but 51.13 coincides with another level that we're looking at here at about 50.70. If the market's able to make it up to this number around 51 or so, and if that coincides with being at about day 13, expect a particularly good chance of a price reversal, or at the very least a pause of this up move that we've seen. That's potentially a very good short opportunity for this crude oil contract, although that pullback or the move downside could simply be a retracement for a continuation back up to the upside of the original trend that we were looking at. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.